Hey everyone, welcome to the FX Talk, Ibri podcast about all things foreign exchange market. My name is Roman Zirok. I'm joined today by our chief economist Enrique Diaz Alvarez and my great colleague from the Warsaw office, Michał Jóźwiak. Summer is unfortunately over, but in the FX market, as traders return from holidays, things often get more interesting. And indeed, we cannot complain about the lack of important headlines, with the latest Fed decision bringing a long-awaited change in monetary policy, which probably heralds more rate adjustments. We also received fresh business activity data from Europe today morning. They were released just hours before the time that we record this podcast. We also had quite a few interesting central bank decisions in the G10, particularly in Scandinavia. So we'll talk about it all, so stay tuned. Let's start with the Fed. As we know, the decision makers cut interest rates by 25 basis points. The decision was almost unanimous. Trump's latest appointee, Stephen Miron, a head of Trump's Council of Economic Advisors and an architect of his trade policy, was the sole dissenter, voting for a 50 basis point cut. The dot plot, which notes expectations of the FOMC members regarding where interest rates will land in the future, leave little doubt that we are in for further cuts. However, we didn't see massive changes there, only with regards to 2025. There was also a huge dispersion of responses between the participants about where they expect rates to land. So let's start with you, Enrique. The decision was expected, but I'm sure there were some aspects of it in the communications, perhaps, that were a bit surprising.
Yes, the market was expecting something even more dovish than just a mere cut. The fact that there was only one dissent, widely expected, Moran, which is seen as the Trump's personal representative in the Federal Reserve, was the only dissenter for a bigger cut. There were a couple of other names that have been mentioned as potential replacements for Chair Powell, who just stuck to a 25 basis point vote. That was seen as less dovish than expected. But I still think that the fact that we're cutting at all, the fact that we're going into a cutting cycle at all, tells you that the Fed is going to prioritize the weakening labor market over the inflation target. We remain in a stagflationary environment in the U.S. Undoubtedly, the labor market is slowing down significantly, especially after the revisions of the BLS to its previous numbers. It's clear that we're in a market where there's very little firing, as layoffs continue to be near all-time lows, but also very little hiring, as which is basically for the last year we've been hiring less than 70,000 net new jobs a month. The trend on that number continues to be down. It's a very difficult scenario for the Federal Reserve, but it's clear that the Federal Reserve has chosen to prioritize reviving the labor market and hopefully the housing market as well, over making sure that the inflation, which remains stuck above 3%, still far from the target, comes down to target.
It's certainly a difficult position for the Fed, considering that the labor market data that we thought is, at least to an extent, in line with reality, turned out not to be. And this suggests that perhaps they should have cut way earlier. And we've got one person on the committee who is particularly dovish right now, Stephen Miron, and he's quite vocal about what he considers a need to lower rates aggressively. And considering that he has a close association with the president, and considering that there is a certain degree of distance from what Miron thinks and what Powell thinks, could it be a concern for markets, particularly for bonds?
Definitely. I mean, I think that something that really sticks out to me is that even though market pricing in of Federal Reserve short-term rates has dropped dramatically over the last few weeks, long-term bonds, 20-year and 30-year bonds, have actually dropped far less. It's the first time that I remember when we have essentially a full Federal Reserve easing cycle priced in the markets with so little effect on the 20 or 30-year bond. And let's not forget that the most important mechanism for transmitting monetary policy to the U.S. economy is probably the mortgage rate, right? The 30-year standardized mortgage rate that most Americans get when they buy a home. The way it used to be is the Federal Reserve cuts rates, that rate comes down dramatically, and people are able to refinance their mortgages or are able to afford a house that they couldn't afford before. And that just reactivates the housing sector, which in turn acts as a lever for the rest of the economy. That is not really happening to the same extent this time. The mortgage rate is linked to the 20-year or 30-year, roughly, end of the curve. Those rates have come down a little bit from the highs this summer, but not very much at all. Definitely not enough to make a significant difference in the housing market. So that's what I'm monitoring and looking at very closely, the fact that the Federal Reserve can only impact directly short-term rates, and the long-term rates that matter most for the U.S. economy are essentially are reacting much more slowly than short-term rates. And that's a bit of an ominous sign for the U.S. bond market.
Let's now turn to the latest economic data. We have received a number of PMI reports from Europe. Particularly in Eurozone, they are important. We do not have the luxury of receiving as many timely economic readings as in the US. Although considering that the quality of some of the US readings, notably the non-farm payroll report, does not seem to be the greatest of late, perhaps we shouldn't be too fast about it. So the key readings investors are focusing on to gauge the strength of economic situation and the prospects of economies are the PMIs, the indicators of business activity. And today's data, I would say, was quite interesting, the data covering September. On the one hand, we have a slight uptick in activity in Eurozone, but not enough to keep investors satisfied. And on the other, we have a pretty gloomy numbers out of the UK, where practically all of the PMI releases disappointed and sometimes really severely. So what do you guys make of this data? Should it catch the attention of the central bankers? Last week, Bank of England left rates steady, and they do not seem to be rushing with further interest rate cuts. So will this data change their mind?
Well, I think that the situation in the Eurozone is quite clear, and the threshold for yet another rate cut is placed really, really high. We've got a modest increase today in PMIs. This is quite promising, however, I think rather uninspiring. And the main point to watch is the rather puzzling dichotomy that we see between France and Germany. Germany is starting to actually hit decent levels with regards to PMIs, 52.4, with still the services sector being the main driver of the economy as it looks, with manufacturing down below 50. But it seems that the 500 billion euros invested in fiscal stimulus starts to have its mark. In France, we have 48.4 with regards to PMIs, so a level which suggests a contraction of economy. This is a rather stark contrast, I would suggest. And well, I don't think that's particularly surprising, considering that we have had yet another government collapse. But in some kind of way, this might be a challenge for the Eurozone to get France out of this sort of weird phase that is going through, with several government collapses and political turmoil going over for, well, a few years now. But I do not think that this will change the ECB mind, and the bank has most likely concluded its easing cycle.
I mean, what I think is interesting in these numbers is that we're seeing, again, this sort of the reappearance of the gap between the manufacturing sector and the service sector. Manufacturing sector is back in contraction in the Eurozone. This is true both of Germany and France. The service sector seems to be expanding healthily and compensating for the contraction in manufacturing and industrial production. That's probably on the back of what amounts to full employment in the Eurozone and the fact that the jobs remain plentiful for now. What is interesting to me is that the effects of that 500 billion euro infrastructure spending announced by Germany now is basically almost 6 months ago, are nowhere to be seen. This was, at least the headline number was very meaningful, and yet industrial production in the Eurozone is stagnant at best. The PMIs, which are the best leading indicator of where the industrial sector is going, are now back in contraction. I am really puzzled. What is happening with this 500 billion that the German government promised in expenditure in both defense and infrastructure? You really think you see some effects by now, if not in production, at least in sentiment, and you're not seeing it. I don't know if Michel or Roman, you guys have an explanation for this. I don't.
Well, I think that most of this effect should be visible next year, at least in part. And we have seen the first positive reading of industrial production from Germany in July. I know that it's not much, but it's something. I think the trend should continue, although, I'm not entirely certain. But this is something to closely follow. And I think that's one of the key trends in the markets to be closely followed in the sort of 2025, late 2025, early 2026, whether Germany will indeed see the effects of this large fiscal stimulus and whether this will help the other European economies, which are largely linked to the Eurozone's largest economy.
I think we'll just have to wait just a little bit longer for the effect to really trickle down. But looking at the PMI numbers from the Eurozone, I wouldn't say that they are particularly great. And I mentioned that investors were left unimpressed because, on the one hand, you had pretty dismal numbers out of France, but also one thing that investors are watching with regards to prospects are new orders, and new orders were basically flat. So this means that the prospects have not really improved, and it seems that with regards to the Eurozone, it's only going to be a waiting game until the effect of the German stimulus plan really is going to start impacting the economy. But probably it's going to start towards the end of the year, the beginning of next year. With regards also to the PMIs, I would probably also focus a bit on the UK numbers, because for a while they held up quite all right. And normally we would see UK PMIs, the composite PMI, on higher levels than in the Eurozone. I mean, this was the situation that we witnessed in recent years. But right now, even though only slightly, the UK composite PMI fell below Eurozone's. And the UK has a lot of economic problems that we have talked about on this podcast in recent episodes. And inflation remains high, but there seem to be increasing problems with the labor market, and now also business activity is getting is not as good as we would have hoped.
Yeah, I mean, you're right. The UK numbers seem to have taken a slight turn for the better over the last few weeks, but these PMI numbers today, these recent PMI numbers with this big unexpected drop, still on expansionary territory overall, but barely. Bucket of cold water on the UK economy. It's hard to be very positive on it.
Yeah, the only positive bit out of the report was probably the aspect about the price pressures. These seem to be at least somewhat normalizing, judging by the PMI report. But this is hardly a consolation, because I think that the one thing that businesses are scared of the most are taxes. We're probably going to get some tax increases in the UK, and at which levels they land, how they will be implemented. This is something that probably is making quite a few business owners lose their sleep. So until we know what the situation is, this dire situation is likely going to remain. And I do not think that the numbers today, they change things significantly with regards to the Bank of England. I mean, with inflation that we are seeing right now, with services inflation printing at around 5%, this is not the time to cut interest rates. Let's move to the last topic, central bank decisions in Scandinavia. This is a region that we don't cover that often on the podcast, and I'm very glad that we have Michał here today, who is covering Scandinavia on a regular basis. So let's start with the Riksbank. Why do you think, Michał, they cut by 25 basis points? And decision of Norges Bank was the same. They also did a 25 basis point reduction. But at least to me, it seems that the position of those central banks is not that similar. Is it the case? Could you tell us a little bit more about the situation?
Well, speaking of disappointing economic growth, I think Sweden is a great example of that. Riksbank has actually mentioned on several occasions, and particularly in the communique that we got, it underlined that the growth has actually disappointed with expectations. So that was, at least in my opinion, one of the key drivers of a sort of early 25 basis point cut. We would have expected that the bank would cut at one of the meetings this year, However, we were not certain that this would happen in September, and this was not the base case for the markets as well. But the bank did, and well, it is sort of a surprise, but the krona has actually gained. And I think largely this is due to expectations of no more cuts in the current cycle. The forward guidance was rather clear. Although the banks think that the economic performance right now is relatively poor, it expects quite a bit better growth in the next year. The forecast for 2026 has actually been brought up with 2.7% of GDP growth. I think that's relatively decent as for Sweden as of late. So I don't think that inflation should be the problem. At least that's what's underlined by the bank. And well, that's a massive difference from the Norges Bank, which is burdened by inflation right now. The headline is at 3.5% with core steady at 3.1%. It looks like it's not going down anytime soon, and that's what has been underlined by the policymakers. So although the Norges Bank did also cut rates, it's not only at considerably higher levels at 4%, which is well more than double of the Riksbank. It's also set to continue to cut rates at a very, very, very slow pace, which is about 25 basis points of cuts per year until 2028. So, well, we could consider that a very, very hawkish cut, which is not really frequent in the markets. So two very different meetings, two very different outlooks from both of the economies. The one thing that connects both countries is actually a very good performance of both currencies this year, which place among the top performance, well, worldwide year to date, which is, well, not surprising for me.
Great. I think we'll wrap things up there.
Yep.
Thank you all very much for tuning in, and we'll catch you all in the next episodes. Thank you.
Thank you.